Picture this. You're sitting across from a loan officer at a bank, and she's about to tell you the biggest number of your financial life, your mortgage rate. And you ask a simple question. Who decided this number? Why is it 6.6%? Why not 5.8? Why not 7.2? And here's what happens. She smiles politely and says something about where rates are right now. That's not an answer. That's a shrug with a keyboard. So let me give you the actual answer. That number wasn't picked by your bank. It wasn't picked by the Federal Reserve. It wasn't picked by anyone in Washington. It was set by a market most people have never looked at once in their entire lives. A market worth about $145 trillion, bigger than every stock market on Earth combined. A market that decides your mortgage, your car loan, your credit card rate, whether your company can afford to hire next quarter, and whether your retirement account loses 17% in a single year.
This market doesn't crash economies. It quietly reprices them while everyone's paying attention to something else, and almost nobody sees it coming until it's already happened. This video isn't about a crash. It's about understanding the invisible machine that controls whether you can afford to borrow money. And by the end of this, you'll know something that most people with finance degrees don't. Who actually decided your 6.6%? Let's start stupidly simple because everyone overcomplicates this. A bond is an IOU. That's it. Somebody needs money. A government, a company, occasionally a city that wants a stadium it absolutely does not need. And instead of going to a bank, they borrow it from investors. You hand over, say, $1,000. They promise two things: a fixed interest payment every year, called the coupon, and your $1,000 back on a specific date called maturity. When Apple needs cheap cash, it sells corporate bonds. When a company with shaky finances borrows, those are junk bonds, which Wall Street renamed high yield because junk doesn't look great in a brochure. Now, here's the part that 90% of people get wrong, and it's the single most important idea in this entire video. Let's say you buy that $1,000 bond paying 2%. You get $20 a year. Fine, boring, whatever. A year later, interest rates rise, and brand new bonds, same $1,000, same borrower, now pay 5%, which is $50 a year. Question: who's buying your bond? You walk up to an investor and say, "Hey, want this thing that pays $20 a year?" And they say, "Why would I do that when the government is handing out $50 a year next door?" Your bond didn't change. It's still paying exactly what it promised, but it's now the financial equivalent of a used iPhone 11. It works fine. Nobody wants it at full price. It sells Treasuries. When Apple needs cheap cash, it sells corporate bonds. When a company with shaky finances borrows, those are junk bonds, which Wall Street renamed high yield because junk doesn't look great in a brochure. Now, here's the part that 90% of people get wrong, and it's the single most important idea in this entire video. Let's say you buy that $1,000 bond paying 2%. You get $20 a year. Fine, boring, whatever. A year later, interest rates rise, and brand new bonds, same $1,000, same borrower, now pay 5%, which is $50 a year. Question: who's buying your bond? You walk up to an investor and say, "Hey, want this thing that pays $20 a year?" And they say, "Why would I do that when the government is handing out $50 a year next door?" Your bond didn't change. It's still paying exactly what it promised, but it's now the financial equivalent of a used iPhone 11. It works fine. Nobody wants it at full price.
The only way to sell it is to cut the price. You drop it until that fixed $20 payment works out to roughly 5% for whoever buys it, which means selling your $1,000 bond for somewhere in the 700s. You just lost a couple $100 on the safe investment. On paper, sure, but on paper has ended careers, collapsed banks, and taken down at least one world leader. So here's the rule: tattoo it somewhere. When interest rates go up, existing bond prices go down. When rates fall, existing bonds go up. They sit on opposite ends of the same lever. Every single thing that's about to destroy your understanding of how money works, every crisis in the rest of this video, it's just this rule operating at a bigger and bigger scale. And the first place it shows up is in a single number that quietly runs your entire financial life. If aliens landed tomorrow and asked to see the one number that controls Earth's economy, you wouldn't show them the Dow. You'd show them the yield on the 10-year U.S. Treasury. Right now, it's sitting around 4.5%. And here's why you should care, even if you've never bought a bond and never plan to. When a bank writes you a mortgage, it doesn't invent the rate. It looks at the 10-year Treasury and asks itself one question: why would I lend money to a random human for 30 years when I could lend it to the U.S. government risk-free at 4.5%? The answer is it wouldn't, unless you pay more. So the bank takes that Treasury yield, adds roughly 2 percentage points for the privilege of you being a regular person who might lose your job, and that's your mortgage rate. 10-year at 4.5%, mortgages at 6.6%. That's not a coincidence, that's literally the formula. Back in early 2021, the 10-year was sitting near 1%, and mortgages hit 2.65%, the lowest ever recorded. People borrowed like the money was expiring. Home prices jumped 19% in a single year against a 50-year average of about 4%. Then the 10-year ripped higher. Mortgages crossed 8% by late 2023, and the housing market basically froze mid-bite like someone hit pause on a nature documentary. The bank didn't do that to you, the bond market did. And it doesn't stop at houses.
Credit cards, student loan refinancing, the rate your city pays to build a school, the rate your employer pays to fund its expansion. All of it is priced off Treasuries. When yields rise, every borrower in America gets the same rate increase at the same time. Companies that loaded up on cheap 3% debt back in 2021 suddenly faced refinancing at 7%. And when your interest bill doubles, you don't write a sad LinkedIn post. You cut costs, which is a polite way of saying layoffs. A chunk of the job losses in 2023 and 2024 weren't really about the economy. They were about the bond market quietly repricing everyone's debt. Oh, and one more party trick. The bond market predicts recessions better than basically every economist alive. Normally, lending money for 10 years.
So while CNBC argues about vibes, the bond market just quietly raises its hand and says, trouble's coming, and it is almost always right. Here's where this gets cinematic, because this exact rule, this one principle about how bond prices move, it started taking down bigger and bigger targets. First a bank, then a country. Watch the dominoes. Domino 1, Silicon Valley Bank, March 2023. SVB took in a flood of deposits during the tech boom and parked over $91 billion of it in long-term bonds. Safe assets, right? Low risk, boring, government bonds and high-quality corporate bonds. Then rates spiked, and by the rule you now know, those bonds silently lost more than $15 billion in value. The bank wasn't gambling on crypto, it wasn't making wild bets, it bought the most boring assets in existence at the worst possible time. The mistake wasn't the strategy, the mistake was that those deposits could leave instantly. When SVB sold part of the portfolio at a $1.8 billion loss and asked investors for fresh cash, depositors panicked. And the bank went from fine to seized by regulators in
Domino 2, the United Kingdom, September 2022. New Prime Minister Liz Truss announced $45 billion of unfunded tax cuts. And the bond market looked at the math and said out loud, absolutely not. Investors dumped UK government bonds so hard that 30-year yields spiked more than a full percentage point in 3 days. That detonated leverage strategies inside British pension funds, which were forced to sell more bonds to raise cash, which pushed yields higher, which forced more selling. A doom loop with the entire retirement system inside it. The Bank of England had to launch emergency bond buying, later admitting some pension funds were hours from collapse. And here's my favorite economic indicator of all time. A British tabloid set up a live stream of a head of iceberg lettuce next to a photo of Truss, asking which would last longer. The lettuce won. She resigned after 45 days, the shortest premiership in British history, because the bond market fired her. Domino 3, Austria. In 2020, Austria sold a 100-year bond, matures in the year 2120, paying a coupon of 0.85%. And investors bought it enthusiastically. Why would anyone lock up money for a century at less than 1%? Because of where the world was at that moment. Roughly $18 trillion of bonds globally had negative yields. Investors were literally paying governments for the privilege of lending to them, the financial equivalent of tipping someone for borrowing your lawnmower. Next to that, Austria's 0.85% looked like a luxury product. Then rates normalized. The negative yield pile evaporated, and that century bond lost roughly 75% of its value from the peak. It's a rock-solid government that will absolutely pay every penny back in the year 2120, but everyone in between owns a sovereign bond that performed like a meme stock without the Reddit memes. One rule, a portfolio, a bank, a pension system, a country. So you'd think after all that, the biggest borrower on earth would be playing it careful right now about debt. About that. The single largest borrower in the history of money is the United States government, and its tab is currently around $38.86 trillion.
Now, big debt numbers are basically white noise at this point. So let me give you the one stat that actually matters. This year, the US will spend over $1 trillion just on interest. Not paying down debt, not building anything, just interest, the minimum payment on the national credit card. For perspective, that's more than the entire defense budget. The United States now spends more money servicing old debt than it spends on the most expensive military in human history.
Interest is now the second biggest line item in the federal budget, behind only Social Security. And on the current path, it eventually takes first place. Imagine your credit card interest costing more than your rent, and your plan is to keep the card. The bond market noticed. In May 2025, Moody's, the last major rating agency still giving America a perfect score, downgraded the U.S. For the first time in over a century, the United States doesn't hold a top credit rating anywhere. The country didn't change overnight. The math just stopped being ignorable. Debt around 100% of GDP and climbing. Deficits near 6% of GDP in a year when nothing's even technically wrong. And the customer base is getting picky. Foreign investors used to hold over half of U.S. Treasuries back in 2008. Today, it's around 30%. China's holdings are the lowest since 2008, so Washington needs to borrow more than ever.
Exactly, while its most reliable customers are slowly backing toward the exit. What does any business do when demand softens? It offers a better deal. In bonds, a better deal means higher yields. We even got a live demonstration. In April 2025, after a chaotic tariff announcement, investors started dumping treasuries. Yields spiked, and within days, the administration paused the tariffs. The president admitted the bond market was getting, quote, a little queasy. Read that again. The policy of the world's most powerful government got reversed in under a week. Not by Congress, not by voters, by bond traders. So why should you, a person with a normal life, care about any of this? I guess because remember the formula. Your mortgage is the 10-year Treasury plus 2. Every dollar of new debt, every downgrade, every nervous foreign investor puts a thumb on the scale that prices your house, your car, and your boss's payroll. The government's credit card bill is your interest rate. So here's what you actually do with all this. First, stop assuming there's no problem because nothing has crashed yet. A forecast is not destiny. The bond market hasn't abandoned the U.S. Not yet, but it's asking questions. And questions are how markets start signaling before they actually move. Second, know the one number that matters. It's not the debt ceiling. Congress will raise it. It never doesn't. The number that matters is the 10-year Treasury yield. When it climbs, mortgages follow. When it falls hard, the market is usually bracing for trouble. It's the closest thing the economy has to a check engine light, and now you're one of the few people who knows what it means. Third, watch your actual portfolio. If you're holding long-duration bonds, which most retirees are without realizing it, you're making a bet on interest rates whether you meant to or not. Bond funds never mature. Rates can rise and leave you with losses on paper. Those losses sit there. They don't bounce back until rates fall. Fourth, stop donating money to your bank. The national average savings account pays about 0.5%. Meanwhile, 3-month Treasury bills pay around 3.7%. Money market funds pay around 4%. Best high-yield savings accounts are right there with them. Same money, same safety, 8 times the interest. And fifth, understand what you actually own. A bond fund is not a bond. A treasury you hold to maturity is guaranteed. A bond fund gets repriced every...
You were always in the game. You just never got handed the rulebook. And there's an entire industry that's perfectly comfortable keeping it that way. But now you know the one rule everything runs on. Rates up, prices down. And you've watched it take down a bank in 48 hours, a prime minister in 45 days, trillions in safe retirement money. And the bond market continues to quietly set the terms of how expensive it is for all of us to borrow. You don't need to trade bonds. You don't need a finance degree. You don't need to predict what happens next. You just need to stop being the only person at the table who doesn't know what that 6.6% actually means. Because the bond market is going to keep pricing your life either way. The only question is whether you can read the price tag. If you want to learn how to turn research like this into content that actually performs on YouTube, even starting from zero, I built a community where I walk people through exactly that. The link's down in the description. That's genuinely all I'll say about it, and it'll be there whenever you're ready. But for now, go look at your mortgage paperwork this week. Actually look. Find out what that rate is, and then think about the invisible market that decided it. Because understanding where that number came from changes how you think about borrowing, saving, and
retirement forever. One last thing, and it's the only boring sentence here. I'm not a financial advisor, and none of this is financial advice. It's just patterns I've watched play out with real numbers attached. Take what's useful and leave the rest. If this changed how you think about interest rates, drop a comment. I actually read them. And if you want to understand the other side of this picture, what happens when bond markets get nervous and what you actually do when they do, there's a full video on that waiting for you right there on the screen. I'll see you in it.